What I'm going to talk about today is the listed property sector. The listed property sector, and for many investors, to simplify in the context of simplicity, it's companies that are listed on stock exchanges, and I'll speak about the JSC, that invest in property companies. And the focus really today would be on how that sector and how we see things as asset managers, and speaking about the retail sector, since it's a conference of around retail. The listed property sector over the last 10 years, and these numbers that I show are August to August. So we're talking August back to 2005 to 2015 August, has been the top performing sector over this period. And in 5 of the periods, as you see on the charts, listed property has been the top performing asset class. So last 12 months to end of August, around 28%, 12 months before that, 20%, 38% a year before that. And if you look at 2010 and 2007, we're talking about numbers of 29% and 39% respectively. So anyone who was in the sector certainly is justified to have a very smug look and go look at your financial plan and why they didn't put you into more listed property over this period. And to simplify as well, if we look at it in rands and cents, if you had invested 100 Rand or 100,000 Rand at the end of August 2005, that 100 Rand would be 603 Rand now if you invested in the listed property sector. It would be 430 Rand if you invested in equities, general equities, pick and pays, MTNs, and those sort of companies. If you held it in bonds, 221, and cash at 203. So the evidence is clear. It's been the top performing sector over the last 10 years, but the focus really is not to think too much about what has happened, but what we see going forward from the sector. And what I want to do before I talk about where we're going is how we got to this point. And what we've done over this period that we look at, let's say maybe the last 10 to 15 years, is look at the listed property sector in 4 chunks. So look at that period in 4 chunks. And I'll explain these different lines on the charts. The green line shows the property yield, effectively the dividend yield that you get out of the property companies. The red shows the bond yield, so what you get out of the bond market. The yellow or the goldish color, we call it mustard yellow color, and there are prizes for anyone who can actually figure out what color that is. That's the color we use in our business. We don't know what it's called. That shows the earnings growth, which is the growth, the income growth that you're getting out of the listed property companies. Now, over this period, starting around 2002, was a period when we call it the genesis of the listed property sector. Not that it started then specifically, actually started way back in the late 80s, but this is when the sector started to come into its own. And over this period, what you see is that a lot of people ignored the sector. We still consider listed property a distant cousin asset class, in that we don't think it gets enough attention for the performance it's shown. But I think at this period, it was the distant cousin of the distant cousin. And over this period, people ignored the sector because someone who managed equities would say, why should I look at listed property? Why should I spend my day looking at listed property when Pick and Pay or Anglos is bigger than the whole sector combined? And obviously that's turned around quite a lot in the last couple of years. But over this period, the listed property sector started to normalize, in effect trade it as a normal sector and start to move in line with bonds. And over this period, investors got around 200% of returns. The next move really was when the sector, we call it the growth phase. And this is, if you see the yellow line shows the listed property sector starting to show strong distribution growth. And this was really the boom years. So 2005 to 2009, obviously the economy was doing very well. We had a consumer boom in South Africa. The retail sector was doing well, so the earnings growth was strong. And the listed property as well has started to normalize. And you start to see that the sector starts to show even stronger returns. You probably got another 200% if you're an investor as early as then. The third phase, which is quite important, but this is when returns really got, I would say, quasi-ridiculous. And that this was when the financial crisis hit, and then in the US, they started what they call stimulus, started to print money. I just want to note that about 2001, I'm from Zimbabwe. We actually pioneered stimulus, the printing money program. This is something that we conceived way before Ben Bernanke came up with this. And over that period, we did get some growth in the income, on the earnings of the companies, but because there was so much money chasing yield, listed property stood out as a sector that showed yield, but also showed growth in earnings. So there was a lot of demand for the sector. So over this period, we've seen all these different phases, and the fourth phase we're in is where we are now. And in that phase, I really have a big question. So we've got normalization, we've got growth, we've got low interest rate environment, and this fourth phase is a big question mark. And the reason why we're in a big question mark is, A, because the sector is not really showing the growth that it was showing between 2009 and 2005. The economy isn't growing to that extent. A lot of shopping centers have been developed where there is risk of oversupply in some markets. So from a fundamental perspective, these returns seem quasi-unjustified from what we've seen in our side. And what you're starting to see is, over if you look at the 2002 period, the listed property sector used to trade at a yield, a forward yield that was higher than what you would get on bonds. So effectively get more income return from the sector as opposed to bonds. Now that's flipped around completely, where the listed property sector is trading at a much lower yield than bonds, but the growth isn't enough to compensate or justify. Now, to put it simply, I think the sector is expensive at this point, and things have run way ahead of themselves. And what we've seen is it's really some other factors that are coming into the sector, and this is to form some sort of background where I think as a sector we're going. Now, where to from here? Now, before I give you a sense of how we see things over the next couple of years, and say 3 to 5, maybe 7 years, is to look at the evolution of the sector. So 10 years ago, 2005, 99% of the sector, the listed property sector, when you bought a share or you bought the index, what you would get is South African property exposure. So exposure to assets in the South African context. Really about 1% of that was stuff that was offshore. And what you really got was retail, office, industrial, retail being about 52% of the sector, and then there was no offshore exposure. But with the evolution of the sector, what you're starting to see, and what you see now, is that 24% of the earnings that are coming from our sector, similar to what's happening with JSE, with Naspers and all the companies, MTN, ETC, 24% of the sector is actually offshore exposure. So you're really not getting a pure South African story, which maybe explains some of the growth rates that we've been getting out of companies. So some of the companies that we've seen are showing growth between 12 and 15%. In a weaker South African environment, this is not really justified. And this is what is creating some of the noise that you're starting to see in our sector. So the sector, in our view, and our conclusion around this matter is that, yes, it is expensive. It's not as expensive as, what first meets the eye, but I would be super cautious because the earnings, 24% at least of the earnings, are coming from offshore, dominated by Romania, US, Australia, and UK. And really, these are countries where you have to look at it slightly differently. Now, looking into what sort of returns you can get from our sector, we always call it our sector. It's very dear to us. And the listed property sector, and how I've done is try and simplify it as much as possible. So the two key things that you must think about, or the two key things that really matter when you look at the listed property sector, is your forward yield and your medium-term growth. And really, over the long term, those are the two things that really drive your total returns. In the short term, however, the biggest risk that you have is what happens in the bond market, because the bond market is looked at as a proxy for where listed property in our context should trade. And in the environment that we're in, interest rates have already started to rise here in South Africa. Interest rates will likely rise in the US by the start of this year, and we're going into a rising interest rate environment.